Welcome to Taking Stock for the week ending 2nd of May 2025, where this week myself, Tim Lincoln, and Kien Trinh, our head of Stock Doctor Research, streamed you all things share market. How are you, Kien?
Yeah, not too bad, Tim. May's upon us, and it's starting to get a bit cold here down in Melbourne.
Yeah, we had a beautiful summer and a fantastic autumn, haven't we? We've been so blessed this year, but it is starting to get a little bit chillier, that's for sure. Hey, Ken, just before we get stuck into formalities today, just a reminder to everyone that all of the information we share today is of a general nature and should not be construed as personal advice. And all of the data and performance metrics that we also share today, all historical in nature and shouldn't be relied upon as a guide for future performance. Well, Kien, it's been a really interesting period, not just across the market, but of course here at Lincoln Indicators and Stock Doctor as well. A couple of weeks ago, we announced to all of our members and investors in our funds that I'd actually sold 100% of Lincoln Indicators to Prime Financial Group, which is incredibly exciting. But I just wanted to take a moment to acknowledge and reassure some of our members on our strategic partnership, what that means, what it entails for the future. And I just wanted to share all of that in the best interests of our members. I don't regard it, Kien, as an acquisition. It's more of a merger. I'm going nowhere, and we're merging with a listed company, Prime Financial Group. Their ticker code is PFG. They've got their CEO, Simon Matter, very similar background to mine. He started Prime with his father around 20 years ago, as I did Lincoln Indicators with my father around 30 years ago. He's got serious growth ambition, as do I. So it's a merger of our two companies to really take our offerings to the world through platforms and full advice services. We'll continue to specialize in what we do. Simon will specialize in what they do, and we bring it all together for this wonderful holistic offering. So the merger marks the beginning of an exciting new chapter, one that will empower us to deliver greater value to you, our members, than we could have ever achieved on our own. Through the support and scale of Prime Financial Group, we'll be better positioned to accelerate key growth initiatives such as the coverage of US equities and global equities, an enhancement that you've all been asking for a little while. We'll be able to do that with their support a whole lot quicker now, to construct not only a global database of analysed equities using our methodology, but also model portfolios and then multi-asset portfolios in time with Prime's expertise as well. So it's so exciting. More broadly, you'll gain access to Prime's comprehensive wealth management capabilities, which span accounting, financial planning, self-managed super fund administration, and alternative investments such as property, private equity, debt instruments, and bonds. In short, the partnership creates a true one-stop shop for all your financial needs. So it's again, it's just incredibly exciting. We've been really fortunate to find the ideal partner. And as Charles Darwin wisely observed, it's not the strongest of the species that survive, nor the most intelligent, but the one that's most responsive to change. At Lincoln, we are embracing change, not for our own sake, not for my own personal gain, not for Lincoln's own individual gain, but to ensure we continue to evolve, thrive, and serve you, our clients and members, in an ever-changing financial landscape with the very, very best and innovative products available. So I'm super positive. If you've got any further questions regarding the merger and acquisition, please give us a call and go and check Prime out in Stock Doctor. Remember, ticker code PFG, and we look forward to a really positive journey over the medium to long term. So now, Kien, let's turn our attention to the markets. And the month of April has been another volatile one for both US and Aussie equities. But this time, in Australia especially, the market was up some 3.6%. So of our members who are able to block out the noise and embrace volatility as opportunity, you've had a pretty good month. The main catalyst was US President Donald Trump's surprise decision to pause reciprocal tariffs for on more than 75 countries for the 90 days. while the US tariffs on China were raised to 125%, the broader easing on tariffs alleviated fears of a full-scale global trade war for now, Kien.
Yeah, it's funny how things can change so drastically and so quickly, Tim.
Yeah.
That's the market for you, the fickle nature of it. But what we also saw, though, was the soft US and Australian economic data, which raised hopes that inflation was finally easing as well. And this also reignited speculation that both the US Fed and the RBA, they could pivot rate cuts. And that should support equity markets, especially sectors that are sensitive to interest rates, including technology and REITs as well. So we saw those sectors recover quite strongly last month. In fact, in Australia, the underlying inflation rate has now dipped below that 3% for the first time in 3 years, Tim. And
Mm.
that's opening the door for interest rate cut in May, with money markets now attaching a 98% probability of a 25 basis point cut.
Well, that's always good for equity markets, isn't it, Kian? And
Mm.
last month's sharp market rebound serves as a powerful reminder in the importance of blocking out the noise and using volatility to our advantage, especially when fear dominates sentiment. And with the federal election here in Australia on tomorrow, and with the May confession season underway, markets are likely to remain pretty volatile. In times like these, I want to reiterate the value of sound risk management. That is maintain a well-diversified portfolio of, at least 15 stocks anchored to financially robust businesses, our financial health model and golden rules, and whether it be growth or income relative to your investment profile and risk profile, and especially those companies that can withstand uncertainty and deliver over the long term.
Yeah, Tim, you mentioned confession season there, and it's really important here that we watch out for the evolving and uncertain US tariff landscape and the impact that has on Australian businesses in the months ahead. So our team will be watching this closely because we've seen a few companies, for instance, Flight Centre, they've issued a 18% profit downgrade and citing concerns over the potential negative reception of international tourists in the US amid the tightening border security measures. But this also comes on the heels of negative updates from several companies as well. We had luxury goods reseller Cettire also under a bit of pressure. Breville also announced issues around tariffs, Ansell, and also Brambles earlier this week. But we'll delve on Brambles later in the episode. But it's an interesting active risk that we're monitoring right now.
Yeah, and with the fickle nature of the tariffs at the moment, announcements is all over the place, isn't it? Sure, we got the 90-day pause, but before that, it was just all over the place. And so it really depends on how long the tariffs remain in place, don't they, and how much they impact on earnings going forward. So you're right, Kian. It's something we have to keep an eye on over the medium to long term, and eventually the effective tariffs will wash through into future financial accounts of companies. But we believe the strong companies will be able to manage any impact on tariffs purely because of their financial strength. Let's now turn to the flurry of resource updates this weekend. There was a stack of them, wasn't there? It's been a mixed bag, though. Some
Mhm.
names delivered solid results while others battled cost pressures and disruptions. Ken, which gold, especially with the gold producers, God, there was a flurry there, wasn't there? So, Ken, which gold producers stood out and how are they now positioned heading into reporting season?
Yeah, we've got quite a bit of exposure there to go, Tim. And among the winners, what we saw was Perseus Mining. Remember, they've got those mines in Africa. You've got Vault Minerals and Capricorn Metals. They posted their third quarter production and costs in line with market expectations. And they also reaffirmed their full year guidance. So that was positive from that front. On the other hand, we had a few companies, gold stocks that took a hit, mainly from short-term kind of unplanned downtime. For instance, Gold Road Resources, they were hit with their Grower Mountain mine there, and also Arabanda and Northern Star, they downgraded their full year production guidance, but that was due to near-term operational challenges. Also, we had Catalyst Metals as well. They were impacted by cyclone disruptions as well. So, yeah, naturally, with these kind of gold stocks, there's always kind of be operational risks that you need to monitor. But the overarching theme, I think, over the last month has been the gold price and how that's come down a bit following the positive sentiment in share markets.
Yeah, that's right. There's a direct correlation there, isn't there? And
Mm.
as we always espouse, Kian, the importance of if you invest in any commodity stocks, then you're going to be obviously have a bit more volatility relative to the underlying commodity, and that's what we've seen with the gold stocks, and especially because they had a terrific run. Obviously, there's a bit of profit taking moved in with some of the more negative production announcements that came through, but that's very normal when you invest in that space.
Mm.
And naturally, also investing in gold stocks comes with operational risk, but I'm sure, Kien, you and your team are, you're reviewing some of these negative announcements to understand whether these stocks should remain in our star stock portfolios, especially if gold price continues to consolidate on and with that downward pressure. So, Kien, I think it's really prudent, therefore, that our members keep a really close eye if they invest in gold stocks and commodity stocks more in general. Keep a really close eye on those earnings revisions under Golden Rule 3. So now turning our attention towards the banking space, Star Income stock. Bank of Queensland released its interim result a few weeks ago. Under Golden Rule 3, Kian, I noticed that the stock has experienced strong earnings revisions. So what has mainly contributed to those revisions of late, Kian?
Yeah, Bank of Queensland, they first off the mark from this bank reporting season, which is expected to kind of play out this month. But regional banks, they've experienced a challenging operating environment with you've got higher funding costs and also competitive pressures across their core business in lending and deposits. And this was reflected in Bendigo Bank's first half result, if you can recall that in February. So investors, they had low expectations leading into this result from the regional bank, Bank of Queensland. But positively, the bank surprised the market and they revealed good progress with their ambitious turnaround by overhauling the bank's cost structure. Remember that the bank is transitioning their owner-managed branches to corporate structures. And in addition to reducing the cost, the bank was able to shift their lending mix from the highly competitive and unprofitable mortgage space. Remember, it's highly competitive, this space, and they're moving towards that higher margin business segment in healthcare and agriculture. And this is helping them sustain their net interest margins. And not only that, but it's allowed them to increase their interim dividend by about 1 cent per share to 18 cents per share.
Oh, very nice. And under Golden Rule 3, the outlook appears promising, with the bank expected to increase its dividends on an unstretched payout ratio of around 65%, which is also positive. And despite the recent share price rally, the stock continues to trade on an attractive gross dividend yield close to 7%, which is also obviously very handy, Kian.
Yeah, definitely, Tim. And this positive sentiment across the banks have moved into all the other banks. So now we're heading into that week on the corporate calendar, and the bank reporting season will take centre stage. You've got Westpac, National Australia Bank, and also ANZ. They're set to release their interim results. So there is a bit of expectations with the rebound in share prices here. So we'll be watching very closely to see if the banks can deliver on the results, especially to justify that recent investor optimism.
And while you're talking about corporate calendars, Kian, we've got a big few weeks coming up too with our Stock Doctor Platinum members. Can't wait to see them all in Melbourne next Tuesday for lunch and Sydney on Thursday for lunch. And then a couple of weeks after that, we jump on a plane and head up to Brisbane to have a beautiful lunch with our Queensland-based Platinum members also. So really looking forward to those functions. And now to Under the Microscope, Kien. And this week we take a closer look at supply chain pallets provider, Brambles Limited, ticker code BXB. First off, Kien, can you please provide viewers with a brief overview of what Brambles actually do?
Certainly, Tim. Brambles, if you think about the business, they are quite a global business and they operate in about 60 countries, primarily through their SHEP brand, managing a pool of approximately about 347 million pallets, crates, and containers. And their business model, it focuses on the pooling and sharing of these assets among multiple supply chain participants. And that promotes efficiency and sustainability, allows supply chains to move. So it's quite an important factor, in especially around these trade wars issues. And supply chain dynamics.
Yeah, so when you see those wooden pallets on trucks, on semi-trailers being trucked around the place with goods on top of them used for, forklifts to put their forks underneath and load them into containers for shipping or just general transportation. That's their core business is the supply and manufacture of those pallets. So it's a fascinating business model, and they certainly do have a serious competitive advantage and a massive global footprint relative to their brand. So wonderful story, wonderful Aussie story, Brambles. Historically, Kien, Brambles has reported a really high return on equity it can be seen under Golden Rule 2 and the full history there, and really strong net profit margins to accompany the high ROE. So what's really driven that really strong historical performance, Kien?
Yeah, Tim, very few companies can generate a return on equity of around 27%, which is quite high. But this strong performance can be attributed to their efficient capital allocation. And also, they're massive, the scalability of their pooling model. So you've got technology and you've got automation processes that allows for productivity and really low incremental costs in the grand scheme of things.
Yep, very good, very impressive. However, the market reacted negatively to their recent trading update, Kien. What was the market mainly concerned about?
Yeah, it was very interesting, their update. They did reaffirm their underlying profit guidance, but they narrowed the guidance. So in FY25 sales revenue growth, that outlook is now expected to move from 4 to 6% to around 4 to 5%. So this adjustment came at the lower end of their guidance band, coupled with the modest volume trends and macroeconomic uncertainties. I think the market was quite cautious in their response.
Hmm. And I love companies that can be used as a global barometer, and Brambles is considered a barometer of global supply chain movements. With the current global trade environment, how might US tariffs potentially impact Brambles, Kian?
Yeah, I think this is where the market's coming from. They're a bit concerned here, and that's why we saw a bit of a sell-off after that announcement. But Brambles, they did come out and indicate that while tariffs may slightly affect the demand, the overall impact is expected to be minimal from their perspective because they've got diversified operations and they focus on essential goods, Tim, like food and beverages. And that does help mitigate some of these risks associated with trade barriers. Hence the reason why earnings revisions, as you can see under Golden Rule 3, they've been quite stable despite the recent announcements.
Yeah, very interesting. And I can see that Brambles has outperformed the market since the beginning of the year, despite the macroeconomic risks. Given the challenges around trade tariffs, do you think the outlook is still positive?
Yeah, in the actual trading update, they did say that they are experiencing sales growth of around 3% despite all this uncertainty, Tim. And in fact, the business has upgraded its free cash flow estimates on the back of CapEx savings and back to that cost efficiency, hence the reason why its return on equity is forecast to be sustained at around 27%.
Okay, potentially another case of volatility creating a little bit of opportunity, Kian. And now the question of the weekend, and with the May confession season underway and ongoing uncertainty around US tariffs, a timely and valuable question for investors is, how can Stock Doctor help me assess the earnings risk of a company during confession season?
Yeah, the active risks are what our analysts are monitoring at the moment, Tim, but there are several powerful tools within Stock Doctor to support this process. The first is you've got to stay across those company announcements under Golden Rule 8. Announcements that trigger sharp share price reactions can signal the shift in earnings risk. So refer to the recent updates as well on the tools menu. You can look at those lists of all the announcements for stocks in your portfolio or watch list and keep on top of that. And for star stocks, our analysts will closely monitor and provide detailed commentary. So be sure to read these insights and especially across those active risk sections and strategic comments. But don't hesitate to call our team for further clarification on this. And for non-covered stocks, You can set alerts to flag price-sensitive announcements in real time as well.
Also, Kien, monitor earnings revisions under Golden Rule 3. Really, really important. Track changes in consensus earnings estimates. If revisions fall below, say, 5%, it warrants a deeper investigation. Alerts can also be set to flag any material changes in analyst forecasts. Additionally, use Golden Rule 5 to track changes in consensus target price as well as a gauge for broader analyst sentiment over the past 3 months.
Yeah, and in addition to this, Tim, under Golden Rule 4, there's also the short interest field as well, which is often overlooked, but provides a window into institutional sentiment. So rising short interest can signal growing skepticism about the stock's outlook, especially valuable given that institutional investors, they often act more objectively than the analyst community, Tim.
Yeah, skepticism is a bit of a tongue twister, isn't it? I understand how you stumbled a little bit there,
Yeah.
Kian, but all good. And just to reinforce what Kian mentioned before, too, if ever you're uncertain about the risks associated with the stock, don't forget, and especially don't hesitate to reach out to our analyst team who'll walk you through any questions you may have on a particular stock. That's all part of the Stock Doctor service. Well, Kian, that's a wrap. That's another taking stock for this week as we head into a really important time of year, which is confession season. So thanks a lot for your wonderful input once again.
Thanks, Tim. A pleasure, and good to have you still here on board, despite, the merger. To see two founders, driving the business forward. That's great to see as well. But and if you have any questions for our clients as well, feel free to come along to our weekly Lincoln Live session on Monday morning, where our team will be here to answer your questions on stocks, the market, and the business developments, Tim.
Yeah, Ken, you said thanks. Great to see I'm still here. I am absolutely still here, and we often need our jets fired a little bit to make sure that we remain deeply passionate about what we do, and the whole Prime merger has just fueled those jets again, and I bet they've fueled yours. I bet they've fueled all the executive team at Lincoln Indicators, together with all the staff, because now even our team have access to things that I could never have provided in the past. So it's one big positive outcome for us all, but especially our Stock Doctor members, where you're going to receive products and services that will be world class. And with our innovative mindset, we're on a mission to build those for you and provide them and obviously support. So I'm going nowhere. My jets are fired, and we're ready for a really, really positive period ahead indeed. So take care, everyone. I hope you enjoyed today's episode. Have a happy, healthy, and prosperous week.